IFRS 1, or First-Time Adoption of International Financial Reporting Standards, is crucial for entities transitioning to IFRS. This standard sets the stage for companies to align their financial reporting with globally accepted norms, ensuring transparency and comparability across borders. It is a significant step for any organization looking to enhance its financial credibility and attract international investors. IFRS 1 provides a comprehensive framework for companies adopting IFRS for the first time, ensuring high-quality initial financial statements. This framework includes guidelines on how to present an opening balance sheet, how to recognize and measure assets and liabilities, and how to disclose the impact of the transition on financial performance. This standard is particularly relevant for companies moving from national GAAP to globally recognized standards. The transition to IFRS can be complex, involving significant changes in accounting policies and practices. However, the benefits of adopting IFRS, such as improved financial reporting and greater access to global capital markets, often outweigh the challenges. The transition might be driven by regulatory needs or strategic goals like enhancing comparability. For instance, companies listed on international stock exchanges may be required to report under IFRS. Additionally, adopting IFRS can help companies streamline their financial reporting processes and improve their internal controls. IFRS 1 aims to balance the benefits of adopting IFRS with the costs involved. It provides exemptions and exceptions to ease the transition process, allowing companies to avoid excessive effort in restating past information where the benefits are limited. This pragmatic approach helps companies focus on the future rather than getting bogged down by historical data. By minimizing the need for extensive historical adjustments, IFRS 1 ensures that companies can transition smoothly without incurring unnecessary costs. This approach not only saves time and resources, but also helps maintain the integrity and reliability of financial statements during the transition period. By applying IFRS 1, entities establish consistent accounting policies for future periods. This consistency is crucial for maintaining the comparability of financial statements over time, which is a key objective of IFRS. It also helps companies build a solid foundation for future financial reporting. Understanding IFRS 1 is essential for finance professionals involved in IFRS transitions. Comprehensive training and education on IFRS 1 can equip finance teams with the knowledge and skills needed to navigate the complexities of the transition process, ensuring a successful and smooth adoption of IFRS. IFRS 1 ensures high-quality first IFRS financial statements, providing a solid foundation for entities transitioning to IFRS for the first time. This standard is crucial for maintaining consistency and reliability in financial reporting. It aims to make financial statements transparent and comparable across different periods, which is essential for stakeholders to make informed decisions. IFRS 1 guides entities in adjusting from previous accounting frameworks to the new IFRS standards, ensuring a smooth and systematic transition. A core principle of IFRS 1 is the retrospective application of IFRS standards, which means applying them as if they had always been in use. This retrospective application helps in maintaining consistency in financial reporting, but it can be quite challenging for entities to implement. Full retrospective application can be challenging, especially for entities with complex financial histories and diverse accounting practices. To address these challenges, IFRS 1 includes exceptions and exemptions. These provisions are designed to ease the transition process. Mandatory exceptions prohibit retrospective application in certain areas like estimates and derecognition. Optional exemptions simplify transition, such as not restating past business combinations. These exemptions are particularly useful for entities that have undergone significant changes like mergers and acquisitions, making the transition more manageable. These options balance comparability and transparency with practical difficulties, ensuring that financial statements remain reliable and useful. IFRS 1's pragmatic approach aids smooth transition, ensuring robust financial information. This approach helps entities provide high-quality financial statements that are both transparent and comparable, ultimately benefiting all stakeholders involved. Establishing the transition date is key in IFRS 1 adoption. This date sets the baseline for the opening IFRS statement of financial position. Entities must recognize assets and liabilities per IFRS, adjusting from previous GAAP. Reclassification and measurement adjustments ensure compliance with IFRS. This process requires understanding both previous GAAP and IFRS standards. Accurate preparation impacts the comparability and reliability of future financial statements. IFRS 1 includes mandatory exceptions and optional exemptions to ease transition. Exceptions prohibit retrospective application in areas like estimates and derecognition. Exemptions allow avoiding full retrospective application, reducing transition costs. Examples include not restating past business combinations and using fair value as deemed cost. These reliefs make IFRS transition feasible, but choices impact reported figures. Strategic evaluation and transparent disclosure of exemptions are crucial. A successful IFRS 1 transition requires thorough planning and assessment. This process is not just about changing numbers on financial statements, it involves a comprehensive review of all financial reporting practices. Companies must ensure that they understand the full scope of IFRS requirements and how they differ from their current GAAP standards. Identify key differences between current GAAP and IFRS, impacting all business areas. This includes recognizing how these differences will affect financial reporting, tax planning, and internal controls. A detailed gap analysis is essential to pinpoint areas that require significant changes. Form a dedicated project team with clear roles and responsibilities. This team should include members from various departments such as finance, IT, and operations to ensure a holistic approach. Regular meetings and updates are crucial to keep the project on track. Design and develop new IFRS accounting policies, considering optional exemptions. These policies should be tailored to the specific needs of the business and should be reviewed by external auditors to ensure compliance. Implement and test new systems, ensuring staff training and issue resolution. This includes updating financial software, training staff on new procedures, and conducting thorough testing to identify and resolve any issues before full implementation. Prepare the first full set of IFRS financial statements with necessary disclosures. This step is critical as it sets the foundation for future reporting and ensures that all financial information is accurately presented. Communicate with stakeholders and conduct a post-implementation review for ongoing compliance. Regular reviews and updates will help address any issues that arise and ensure that the company remains compliant with IFRS standards in the long term. Data gathering and restatement complexity is a major IFRS 1 challenge. Start early and use robust data management systems to streamline efforts. Lack of IFRS expertise can be addressed with training and external consultants. Transition impacts IT systems. Phased implementation and early IT involvement help. Manage stakeholder expectations with clear communication and transparent disclosures. IFRS adoption enhances financial statement comparability globally. It improves transparency with extensive disclosures, building trust with stakeholders. Access to global capital markets increases, broadening investor base and lowering capital costs. Multinational corporations benefit from streamlined reporting and cost savings. Consistent accounting policies enhance internal management reporting and decision-making.